Hey folks, Dan Frio here, the rate update. And today's video, I want to kind of go through, there's buzzword out in the street of, home affordability is getting out of hand. And I want you to watch this video because it's a myth. The numbers behind everything make sense.
Welcome to another Presentation Expressway. There is so much in the media today about affordability and affordability being out of control, affordability being something where people cannot purchase homes. It's going to cause another crash in the housing market. There are so many misconceptions, so we'll start at the very beginning. It should be noted that affordability in the United States right now is at one of its best levels in history. It's with prices going up. So how can that be? We'll address that. But first, let's understand that many people look at affordability because it's obviously important. However, the metrics that they use are oftentimes incorrect. Just because home prices are going up does not necessarily mean they're less affordable. But it can be a contributing factor, of course. So what we want to do first is make sure that we're looking at the right metrics. And the media does not do that. They look at something called median home price. Now, median home price literally means that half of the homes were purchased above that median home price and half below, which is why it's the median home price. That recently has gone up over 15%. But that's simply because there is much less inventory on the lower end, so there are fewer transactions on the lower end, and that moves the median home price up. Doesn't mean home prices are actually going up that much. Home prices are actually going up, as measured most recently, around 7%. Now that's still pretty big, but 7% can be something that's ahead of what people are seeing as increases in their income. Now, once again, we want to look at the right metric. So many people look at hourly earnings. That's the wrong one. You want to look at weekly earnings because you can work more or less hours, but your weekly earnings, that's what you get. And weekly earnings recently have been going up at about 5.9% year over year. Now, somebody might still say, well, weekly earnings are less than appreciation. Well, let's also take that myth out of play. Now, let's assume for a minute we're going to do some simple terms here. A year ago, you could have purchased a home, and the monthly payment for principal and interest, just principal and interest, would have been $1,000 a month. Now, to qualify for that, your income would have had to have been roughly $5,000. And that's just the averages that we got from Fannie Mae and Freddie Mac. So when we look at these numbers for principal and interest at $1,000 a month and income for $5,000 a month, that's what it would have been a year ago, except a year ago they did not make the purchase of the home because maybe they listened to people in the media and all the scare tactics out there and all the misconceptions out there, and they stayed away. Now this year, they realize after talking to someone like you that housing is a great opportunity, so they want to move forward. But that home price went up by 5%. Now, in this particular instance, let's just say interest rates remain the same. So that means that they'd have to borrow 5% more, which means that their payment would go up by 5%. That means their payment would go at a 5% rise, brings it to $1,050 a month. So that 5% rise is $50 a month. That's 5% of $1,000. So their total monthly payment is $1,050. Now, $1,050 monthly payment means that it's $50 more a month that they need to get as an increase in income to offset that. So that means their income would have to rise from $5,000 a month to $5,050 a month to offset that. Now they'd be in that same level of affordability. So what percentage rise in income did they need to make that extra $50 a month? Well, it's not 5%, it is 1%. So this is a misconception because when you look at the math numbers, you don't use all of your money from your income for your housing. Because you use a fraction of that, you don't need as much of a rise in income to offset an increase in home prices. And this is a very important concept. Now, if we want to tie this all together, let's take a look at an example. Now, let's just say we're looking at something in the fourth quarter of 2019 versus the fourth quarter of 2020. And somebody today is looking at a home that has had 7% home price appreciation over the past year. And today that home is at $350,000. Now, because that home appreciated 7% a year ago, that home was worth approximately $327,000. So in the last year, thanks to appreciation, that home has gained $22,900. Obviously, it would have been better to buy it last year, but home values are expected to continue to rise. Now, when it comes to affordability, let's take a quick peek at what's happened. The 30-year fixed rate a year ago was 3.75. Today it's around 2.75. And I know these numbers can change, but we're using this more for conceptual purposes. So it's been about a 1% drop in interest rates year over year. The loan amount, say they're putting 10% down, so a 90% loan to value means they borrow roughly $294,400, or today $315,000. So they have to borrow $20,600 more in order to make this transaction happen. And that's where the media says, well, now that's less affordable because you have to borrow more money. That means you're going to have more in monthly payment. But because rates have dropped so much, instead of last year's payment on the lower priced home value, I should say, it'd be $1,363. Today, even with that home appreciating, to make that same monthly payment on 90% financing, it would be less by $77. Now, in all fairness, the loan amount's bigger. It's 10% down. You might have to pay some more in mortgage insurance. So let's calculate that. The mortgage insurance, this depends, of course, on credit score. We understand that. But just to give some general numbers, it's about $8 a month more in mortgage insurance. That brings your net lower payment this year versus last year to $69 a month. So the same home is going to cost you $69 a month less, even though it went up almost $23,000 in price. The media sees the $23,000 gain and they say, well, it's less affordable. When in reality, when you do the math, it is more affordable, but it goes much deeper than that. Now, listen, let's be fair about this and let's understand that the down payment on a lower priced home is less than a higher priced home. So there's about $2,290 more in cash that they would need. If you were to translate this into a difference in monthly payment, it'd be about $10 a month if you were to, in some cases, finance this. And I don't want to go in too deep on the differences in mortgage insurance, but in many cases, this would be $10, maybe it's $15 or whatever it is on a monthly basis that you'd be looking to if you wanted to finance this difference instead of putting it into cash down payment. So that'll bring you around $59 a month. Let's even call it $50 a month cheaper. The bottom line is it's cheaper. But wait a minute, something else is happening that's very important. Your income. If your income needed was about $5,000 a month to make this payment work, well, then if you received an increase, like the statistics say, on weekly earnings of 5.9%, well, then your income last year, $5,000, means this year it's almost $5,300. So your payment drops and your income goes up. This is being more affordable, not less affordable.